Hello and welcome everyone to another market commentary from StashAway. With me, of course, our Chief Investment Officer, Freddy Lim. Freddy, how are you?
I'm very well, Philip. It's good to see you. Lots of things are happening all the time, but it's good to catch up periodically.
It's good. It's good to catch up. How are you feeling about the new restrictions put in place again? Do you think any long term impact from that, or is this very much putting the fire extinguisher on a small?
It's always been expected that you have this tussle. You win some and then you lose back some grounds until the vaccination drive is fully finished. And even with the vaccines, like it's not exactly 100%, right? So there will be a tussle. But we need to just get through the vaccination drive before we think about anything else. So this is the tussle right now.
Yeah, no, it is a tussle. It's a tussle, but we're getting through it. We're getting through it. We have to stay positive. Freddie, we got so many questions today, right? We really want to make sure that we capture them all. So let's get right into it. The first one is from Yong Jun Ren. He was actually reaching out to our customer engagement team and was referring to reading Ray Dalio's book on debt cycles and the changing world order, right? And his question around that is, will inflation and, in addition, the US devaluation risk to certain asset vehicles to StashAway's portfolio? If yes, and then to what extent would that happen?
Well, firstly, this is a two-part thing, right? But let's talk about the debt cycle first. The idea is that governments have basically borrowed too much and been getting away with repaying it. And thankfully, interest rates been on the drop for many decades. So the cost of financing those debts have been very low. But the key equation is that as long as the GDP growth rate is higher than the cost of financing the national debt, then things are okay. And for an open U.S. economy that trades around the world with its reserve currency status, the debt cycle hasn't been a problem. The last cycle we got worried in 2010 after all the stimulus that's done in the 2008 crisis. We got worried about it as well, and then it didn't happen as well. This time we get away with it. So it's a deep question. So Philip, sorry, I'm going to take this because it has to do with whether we think governments, especially US government, is going to maintain its reserve currency status. And I think the cryptocurrency as a cohort is now challenging the sovereignty of paper money, and not just the US, but every government. And who knows what will happen in that tussle again. And so, yes, that concern gets bring out of time, but it's a very long-term development. Now, two, getting back to the question, we have been preparing for this. So, as you knew, back in mid-May last year, we reoptimized portfolios to go from all weather everywhere but US to all weather everywhere, including US, and also to reoptimize to avoid the dollar depreciation risk. So it was a very mathematically driven decision because when you tally the amount of stimulus done by governments, the US by far has done more than the other side. In the currency, there's always two pairs, right? One country against the other. And so, and say, for example, in Singapore, we printed 20% of GDP. But in our case, when we accounted for how much money will multiply in the system, we found that the US actually printed nearly 2/3 of its GDP effectively, if you account for the secondary effects. And so, of course, the US dollar would depreciate, and it has already depreciated. So whatever we have said and be concerned with is already seen happened, right? So, Philip, we know that the dollar dropped 10, 12% on a trade-weighted basis already. Yeah. So this already happened. And that our decision back in May last year has avoided those depreciation risks. So that's exactly what we did. And that's why we have a lot of go for this unprecedented times of stimulating. And we also have, when we invest in tech, we try to avoid US dollar exposure as well. And so we get into China innovations as a way to get away from that. So everything happens for a reason, and precisely for this reason.
Yeah, no, absolutely. Thank you, Jung Jun Ren, for the questions. Hopefully, that was a good answer from Freddie there for you. Freddie, next question was from Mark, and Mark is saying, "Hey, StashAway team, seeing a lot of articles and videos about an upcoming market crash. In case the worst thing would happen, how would StashAway's algorithm protect us from such catastrophic movements in the market?"
I thought we've been around for more than 4 years now, and the last 4 years wasn't exactly greenfield. 2018, we had two market corrections because of Donald Trump's trade war. Last year, we had COVID, which is the second most unprecedented situation for markets and the fastest drop ever, I think, but the second deepest. So we've been baptized by fire as a firm, and our algorithm's been baptized by fire for the last 4 years. And if you look at our track record, short term, always going to be a bit more movie, but if you look at it, given enough time, 1 year, 2 year, 3 year, 4 year, all the consistencies in returns in terms of yearly average has been there. So I think the question is asking us, but like we have been doing this. That's my answer.
Yeah, absolutely. Next question is from Wood Liao. He's saying, according to Warren Buffett, wide diversification is only required when investors do not understand what they're doing. In other words, he's saying if you diversify too much, you might not lose much, but you won't gain much either, right? So this is a big conundrum that you hear sometimes come up, right? Because
I feel like this thing is actually masking a few complications, this question. First of all, when you are investing broadly across indices that's based on market values, so like for example, ExxonMobil last year dropped out of some broad indices and Tesla came in. So the ETF approach of tracking indices, tracking asset classes will drop ExxonMobil and will buy Tesla. So it sort of avoided those problems of being stuck with a name that's no longer in there. So that already been addressed by the rebalancing mechanism that's pretty much automated in our world, right? So that's the benefit of diversification. However, you can then bring it further and say, I diversify across different asset classes. It's not just the stock markets. Then how much is too much is really hard to you have to quantify. Like as any retail, if we are just retail investors, like what metrics do you have to know when you are overdoing diversification? So for StashAway, for us, it's easy because every asset class that we add onto our list, we look at whether it contributes. It contributes by having differentiated return, meaning we will stress test the numbers backward to in time and see whether they bring protection to the portfolio when things are not good, right? For example, when things are good, does it have its own independent mind? Does it have lower correlations? So these are the stuff that we do in the background when we select funds. That's why some people say, why don't you have this? Why don't you have that? But the reason is because we consider whether it actually adds value to the list or not. By adding value, I mean, is it low correlation? Does it offer protection when the other guys are down? So this is the meaning of true diversification. I don't think diversification can be counted by just counting the number of assets you have in your portfolio. It can only be counted by looking at the correlation metrics and looking at the correlation metrics against many different environments to see how they behave, even in greater details. And that's what we do at StashAway.
Yeah, and I think that's you do it. You explain it actually really well in our deep dive seminar when we look at the different efficient portfolios, the efficient frontier, and how you place them on there, right? By adding these different aspects. So, with Liao, if you want to have more insights on this, you can actually go on our app on our Academy. Freddy actually recorded his deep dive seminar there as well. So, if you want to learn a little bit more about that and how StashAway does it, feel free to do that. Next question is from Lee Hyung Chong. He's asking, the Biden administration is proposing to hike capital gains tax. Freddy, this was obviously over the last 2 weeks, right? There was like a lot of news around it. But obviously someone has to pay for the 6 trillion in debt that they're trying to accumulate here for various infrastructure and stimulus checks. How would that affect StashAway investments in the US as well as outside the US, without overall sentiment being dragged down over longer periods of time?
I think it's a short-term thing. Short-term sentiments being driven down and already happened. Market rebounded from there. Market is always forward-looking, but the mechanics is more like, people worry if when you hike capital gains tax, you actually penalize people for making short-term trading decisions in their investments, right? Like if I make a profit this year and I close a position, I will have a higher capital gains tax on this thing. However, then it forces people to take a longer-term view to their investments, and it's actually a good thing because it makes people think long-term. It removes the short bias in the near term, right? So in a way, I actually see it as being better for long-term investors like ourselves with this capital gains tax hike.
Yeah, because I think, a lot of people are worried that people, one of the things about capital gains tax is also when you hike this, they say less money flows into investments, right? And into companies. But I do agree with you, Freddy, that it could actually be a net positive overall because, it makes people think twice about selling their investments as well, right? Instead holding it, collecting dividends or whatever that means, and getting more gains long term. So thank you, Freddy, for all those answers to all these questions. I want to also give a shout out to Jason Lim. He's saying thank you for the commentary. He's great to hear about the rationale during your gold allocation that you had last time, Freddy. At least now he can understand that it's not negative correlated to equities. So that's great. Thank you, Jason, for that shout out. We really appreciate it. We also have a couple more upcoming webinars for our Singapore audience today. We have on the 20th of May, 7 to 8 p.m. Joint webinar, it's Propseller x StashAway, and we're going to talk about buying versus renting a property. In Malaysia, on the 12th of May, we have our How to Invest the Right Way with ETFs webinar. And for our MENA region, we have, again, also How to Invest the Right Way with ETFs, also 12th of May at 12:30 to 1:30 p.m. local time. Again, all of those links to sign up for those events are in the show notes below, as well as on our website, social channels, wherever else you can find us. Again, it's a pleasure, as always, speaking with everyone, and keep the questions coming. Freddy and myself will be happy to answer them again going forward. Until then, have a wonderful week. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.